Ever wondered what those complex trading terms actually mean? They're not just fancy lingo, they're the keys to mastering the market. So, buckle up, because we're about to unravel the jargon in part 3 of our Technical Trading Dictionary series. Starting off with chart patterns. These are the footprints of market sentiment, the historical evidence of what traders have done in the past. Chart patterns emerge across different time frames and signify the rhythm of buying and selling. These patterns, which can take the shape of triangles, rectangles, or even the head and shoulders of a person, have been studied and categorized over the years. They are predictive tools that traders use to anticipate future price movements. When a certain pattern emerges on a chart, it can suggest what might happen next. For example, a double top pattern could indicate a reversal in a rising market, signaling that it's time to sell. Just like a detective looking for clues, traders study chart patterns to predict the next move in the market. Remember, these patterns are like footprints of market sentiment. Next up, we have point of control, or POC. This is a key term that every trader should have in their vocabulary. It's a powerful concept that can help us navigate the market's ebb and flow. But what is it exactly? Well, the point of control is the price level from the past with the highest traded volume. It's a level where the most trading activity occurred, a level that the market deemed most fair. Now here's where things get interesting. This point of control acts as a magnet for future price action. It's like the market has a memory, and it remembers where it has been most comfortable. It's a point that can attract the price back to it time and time again. So when you're plotting your next move, don't forget to consider the POC. It's a significant signpost on your trading journey. So POC essentially directs future price action. Now let's move on to some core trading concepts. These are the fundamentals, the building blocks that make up every trader's strategy. So buckle up, because we're about to go deep. First off, positional trading. This is a strategy where traders aim to buy at monthly lows and hold their position for extended periods. The goal? To profit from price increases over time. It's all about patience and long-term market trends. Whether it's a day, a week, or a month, understanding the duration is key. Remember, slow and steady can win the race. Moving on to rally. A rally is a sustained increase in the price of a security or the overall market. It's the light at the end of the tunnel for traders after a downward trend. Keep in mind, though, that not all rallies are created equal. Some may signal a market turnaround, while others could just be temporary upticks in a longer-term downtrend. Next up, ROE. No, not Roe v. Wade, but return on equity. This is a measure of a corporation's profitability that reveals how much profit a company generates with the money shareholders have invested. High ROE? Good news for investors. Now RR, or risk-to-reward ratio. This is a measure used by many traders to compare the expected returns of an investment to the potential risk undertaken to capture these returns. A ratio of 1 to 3, for instance, means you're risking 1 unit to potentially make 3. Balancing risk and reward is crucial in trading. Finally, we have sell-off. This is a rapid selling of securities, like stocks and bonds. A sell-off can occur for many reasons, such as the release of disappointing earnings reports or negative macroeconomic news, but remember, one person's sell-off can be another's buying opportunity. And with that, we've covered some core trading concepts. Whether it's understanding the patience required in positional trading, the optimism of a rally, the importance of high ROE, the balance of the risk-to-reward ratio, or the opportunities in a sell-off, these concepts are fundamental to your trading journey. They can help you navigate the market's ups and downs, and ultimately make more informed trading decisions. Understanding the duration is key in positional trading. So keep learning, stay curious, and remember, knowledge is the trader's greatest asset. Up next, we'll be decoding market conditions and trading actions. Stay tuned. Understanding your market conditions is crucial. It's like being a sailor. You need to understand the winds, the current, and the weather. In trading, you need to understand the market conditions, the trends, and the actions you can take. Let's dive into it. First up, let's talk about the short position. No, it's not about being short on time or short on cash. It's about betting on prices falling. In a short position, traders borrow a security, say a stock, sell it at the current market price, and then buy it back when the price drops. The difference between the selling price and the buying price is their profit. But remember, it's a high-risk game. If the price rises instead of falling, you could be in for a loss. Next, we have the sideways market. Picture a car stuck in traffic, moving neither forward nor backward. That's a sideways market for you. It's a period of uncertainty, where the prices move within a tight range, reflecting an equal amount of supply and demand. There's no clear bullish or bearish trend, and the market is waiting, perhaps for a news event, an earnings report, or a change in economic conditions to decide its next direction. Imagine you're in a tug-of-war game. The rope moves to and fro, but it doesn't really go anywhere. That's a sideways market. But remember, it doesn't last forever. Sooner or later, the market will break out, either upward, a bull market, or downward, a bear market. The key is to stay patient and keep a close watch. And then we have the spread. No, not the kind you put on your toast. In trading, the spread refers to the difference between the bid price, the highest price someone is willing to pay for a security, and the ask price, the lowest price someone is willing to sell a security for. The spread can give you an idea of the liquidity of the market. The smaller the spread, the more liquid the market. Think of it as a market stall. If you have a lot of buyers and sellers, you'll have a small spread because there's a lot of competition. If you have only a few buyers and sellers, the spread will be larger. Understanding these concepts can help you navigate the market more effectively. You'll know when to take a short position, how to handle a sideways market, and how to use the spread to your advantage. Remember, a sideways market indicates indecision, no clear up or down trends. But like a sailor waiting for the right wind, a trader waits for the right market conditions. So keep your eyes on the horizon, your hands on the wheel, and keep sailing through the market waves. Until next time, traders. Getting more advanced now. As we delve deeper into the trading dictionary, let's start with support and resistance. No, we're not talking about a physics class here. In the trading world, these terms represent the price levels that, historically, a stock has not fallen below or risen above. They are essentially the zones where buyers and sellers have previously drawn a line in the sand, leading prices to bounce back or retract. Imagine a ball bouncing off the floor. That's your support, the price level that the stock's not going below. Now think of the ball hitting the ceiling. That's resistance, the price level it's struggling to break through. But remember, these are not set in stone. A strong enough price movement can break these levels and set new ones. Next up, we have stop loss. This is one of the most crucial tools in your trading arsenal. A stop loss is a predetermined level at which a trader will sell a stock to avoid further losses. Think of it as your safety net, ensuring that even if a trade goes south, your losses are cut off at a level you're comfortable with. It's like having a sparring partner who throws in the towel when things get too rough. Moving on to swing trade, this is a style of trading where the trader holds a position for a few days to a few weeks, trying to capture the swings in the price. It's all about riding the wave of market volatility. Swing traders are the surfers of the trading world, catching waves of price movements and getting off before they crash. Now let's talk about time frame. This is the period that a trader chooses to analyze. It could be as short as a minute for a day trader, or as long as a year for a long-term investor. Choosing the right time frame is like choosing the right lens for a camera. It helps you focus on what's important. Lastly, we have trading charts. A trading chart is a graphical representation of price movements over a specific time frame. It's the map that guides traders through the landscape of the market. There are various types of charts, including line charts, bar charts, and the popular candlestick charts, each with its own way of presenting information, but all aiming to help you make sense of the market's movements. And there you have it, some of the advanced terms and tools that can help you navigate the market more effectively. Remember, trading is not just about buying low and selling high. It's about understanding the market's language and using the right tools to interpret its signals. And I can't stress this enough. Stop loss. It can save you from significant losses by cutting losses automatically. So don't overlook it. Make it your best friend. It might just be the lifesaver you need when the market gets choppy. Enjoyed diving deep into the trading dictionary. If you found our journey through the maze of market jargon enlightening, why not let us know? Give us a thumbs up if you've learned something new. Your likes fuel our mission to demystify the world of trading, one term at a time. Well, there's a simple solution for that. Hit that subscribe button and ring the bell to stay updated. By subscribing, you're not only giving us a virtual high five, but also ensuring you're in the loop for our upcoming content. We're far from done. This series is a treasure trove of trading terms and concepts, all set to empower you on your journey. So keep your curiosity piqued and your learning cap on. Thanks for watching, and that's a wrap on part 3 of our technical trading dictionary. We've covered a lot of ground today, from chart patterns to the point of control and beyond. We hope you're feeling a bit more fluent in the language of trading. Remember, knowledge is power, and each term you learn makes you a more informed and savvy trader. So until next time, stay curious, stay sharp, and keep trading smart.